Hey guys, we wanted to tell you a little bit about reverse mortgages and how they work. Now, the main advantage to a reverse mortgage, of course, is that you get to eliminate your monthly mortgage payments. This allows you to free up more of your income while still owning your home and still being able to live in your home. Now, the way it works, of course, is that the monthly interest on your loan accrues on top of your principal balance. So every month your balance does go up, not down. And of course, taxes and insurance are still due on your property like normal. There are some eligibility requirements to get a reverse mortgage. So first, you have to be 62 years of age or over, and you must live in your home for the entire duration of the loan. Age does matter here, guys. So, for example, older borrowers can access more of the equity in their home, while younger borrowers can access less of this equity. And we're going to give you an example of that in just a little bit. So, let's talk about more benefits to a reverse mortgage. So, if you're on a retired income or a fixed income, by eliminating your housing payment, of course, it frees up more of your income to live your life. You can also consolidate and convert debt into your mortgage. So, if you have credit card debt, car payments, etc., you can pay all those off into your mortgage and eliminate those payments on top of also eliminating your monthly mortgage payment. You can also use the equity in your home to access that as cash and pay for things like in-home care. We've had some borrowers that have made home modifications, things like a stair lift, special beds, or ramps. You can also use a reverse mortgage if your retirement accounts are sort of running low, if your assets are running low and you need to supplement your monthly income to sustain your lifestyle as long as possible. A reverse mortgage is good to do that. Let's look at a sample borrower. Here we have Mary Ellis. Mary is 82 years of age. She has a 700 FICO score. Mary's home is worth $495,000 and she has a mortgage balance of $74,000. She pays per month $1,342. Mary needs to pay for in home care and she wants to supplement her income because her retirement assets are running low. Let's look at her loan example. At 82 years of age, she would start with a loan amount of $259,380. Now, from that, we're going to subtract her mortgage balance, closing costs, and FHA's upfront mortgage insurance premium. Now, guys, FHA's mortgage insurance premium is what allows all of this to happen. That mortgage insurance protects lenders against losses on these types of loans. Now, remember, we said that age does matter. So, had Mary been 90 years of age, she could start with a loan amount of $313,830. After paying off her mortgage, after paying off closing costs, and after paying off FHA's mortgage insurance, she would have a total $226,000 available to her. Now, let's look at how Mary can access these funds. So she has some distribution options. First, Mary could take this as one lump sum. She'd have access to $68,000 her first year and $103,000 year two or thereafter. She can take that $103,000 as an equity line as well if she needs to. Or Mary can take all of it as an equity line and draw upon the fund as needed. She can also take a fixed monthly draw. She could draw, for example, $5,000 a month for 55 months. Mary can also take tenured payments. Now, what that means is she could receive a payment for as long as she lives in the home. In Mary's case, that payment would be $1,938 per month. Additionally, let's not forget that Mary would be eliminating $1,342 of her monthly mortgage payments. So that's an added benefit. Now, the big question is what happens to Mary's loan balance? So let's look at what a reverse amortization loan looks like. So to start, year one, Mary's loan balance would be 167,000, and she'd have a remaining equity line of 111,000. So yes, guys, the equity line does go up. Why is that? Because Mary's estimated home value is also going to go up. As you can see at year one, we estimate that it would be 514,000. That means that the available equity on her home also goes up. If you look at year five, Mary's loan balance goes up, so does her remaining equity line, but her home value also goes up, and so does the equity in her home. So, year seven, same thing, balance goes up, but so does Mary's home. It's worth more. So, what happens here, guys, is that the equity in the home sort of makes up for that loan balance going up. And also remember that Mary would never owe more on her home than what the home is worth. So, she's protected. There you have it, guys. That's how a little bit about how reverse mortgages work. If you have any questions, please, we'd love to help. Give us a call. Our contact information is on the screen. Thank you.